What's happening, guys, and welcome back to our channel. Pullbacks provide a plethora of trade chances when an active trend thrusts higher or down. However, benefiting from this traditional technique is no more than it appears. We've got you covered with 4 stock pullback tricks you need to master. Buy dips like a pro. Number 4. Choosing the best entry price. Let's go through the best technical circumstances for a pullback to convert into a strong trend so that other pullback players may line up right behind you, ready to step in and transform your idea into a reliable profit. Securities that rise to new highs or fall to new lows meet this requirement after they've moved well beyond a significant breakout or breakdown level. Vertical action into a peak or through is also required for continuous gains, particularly on higher than normal volume, because it stimulates fast price movement once you've positioned yourself. It's also preferable when the trading security reverses swiftly after topping or bottoming off, rather than forming a significant consolidation or trading range. Once the pullback is in action, look for cross-verification. This phrase refers to tight price zones where many forms of support or resistance line up, promoting a quick reversal and a strong shove in the major trend's direction. When this zone is tightly squeezed and several types of support or resistance line up precisely, the chances of a bounce or rollover rise, a sell-off to a breakthrough through horizontal highs. It also coincides with a crucial Fibonacci retracement and an intermediate moving average, such as the 50-day EMA, which substantially increases the probability of a successful retreat trade. Even so, you may enter pullbacks in less favorable conditions by scaling into clashing price levels and interpreting support and resistance as price activity bands rather than thin lines. After a well-known hedge fund manager joins the business, Janus Capital Group, or JNS, carves out a 9-month trading range with resistance at 13 and goes vertical in a large volume breakthrough. The news results in a massive 1-day gain, followed by an instant pullback that falls on fresh support at the top of the range, which is now precisely lined with the 62% Fibonacci retracement and 50-day EMA. The stock reverses course, returning to above 15 and restarting to rise at a slower rate. 2 months later, it reaches a 6-year high. Number 3. Taking advantage of available opportunities. Take profits following trade entry or scale out, accumulating funds when the security recovers are losing ground. Place Fibonacci grids over A, the final wave of the major trend, and B, the whole pullback wave to tailor risk management to the characteristics of that retracement pattern. This combination can indicate harmonic price levels when the 2 grids intersect, indicating potential limits. Gaps and tiny trading ranges should also be monitored for counterswings, since retreat always risks printing lower highs in uptrends and lower lows in downtrends. Most exits will come when price advances swiftly in your direction into an evident barrier, such as the last significant swing high in an uptrend or swing low in a downtrend. In November, Marathon Oil MRO breaches a 19-month support level of 31 in conjunction with falling crude oil prices. A few weeks later, the high volume fall bottoms around 24.28, paving the way for a pullback that pauses at the 38% Fibonacci sell-off retracement, allowing for a low-risk short sale pullback entry. A second retracement grid put over the pullback wave aids in trade management by identifying natural zones where the decline may halt or reverse. Number 2. Stop-loss strategies that work. Losing trades with pullback plays are usually the result of 3 factors. First, you underestimate the size of the counter-trend wave and enter too soon. Second, you enter at the ideal price, but the counter-trend continues, shattering the logical mathematics that triggered your entry signals. Third, the bounce or rollover begins, but then fails, crossing over the entry price due to your risk management plan failure. The last instance is the simplest to handle. As soon as your position swings in your favor, place a trailing stop behind it and modify it as your profit grows. The stop required when you first start the position is directly connected to the entrance price. As you acquire expertise, you'll realize that many pullbacks have a sensible entry on several levels. The more you wait and the deeper you go without breaching the technicals, the easier it is to set a stop a few ticks or cents behind a big cross verification level. A deep entry approach will miss ideal reversals at intermediate levels, but it will generate the highest gains and the lowest losses. Suppose you prefer to take several shots at intermediate levels. In that case, position size should be decreased and stops should be put at arbitrary loss levels such as 20 to 50 cent exposure on a blue chip and $1 to $2 exposure on a high beta company such as Junior Biotech or China Play. JCPenney JCP rises over a 9-month trend line to a 52-week high of 11.31. After carving a 3-week trading range, it begins to fall in mid-September and rests on triple support at the trend line 50 and 200-day EMAs. The stock recovers near support, attracting dip buyers, but the recovery wave stalls, resulting in a failed breakout. A pullback play on the bounce necessitates a stop loss below that session's low red line, since price movement into that level will provide a variety of sell signals. Number 1. Look for these things when you trade. Firstly, look at the trade in the trend's direction. The first stage in pullback trading is identifying a trend that applies to your period and then trading in its direction. For example, if you trade the daily period, you must have a daily time frame trend. Alternatively, if you trade on the 1 hour, you must have a trend on the hourly time frame. You should remember that the market must be trending for pullback trading to be effective, which means you can ignore range market conditions. Secondly, determine the nature of the trend. All trends are not supposed to be equal. Some of them have minor pullbacks, while others have significant pullbacks. So these are the 3 sorts of trends that every trader should be aware of. First is a strong trend. The price follows and maintains above the 20 MA. Second is a healthy trend. The price respects and keeps above the 50 MA. Next is the weak trend. The price respects and holds above the 200 MA. Knowing these trends is essential. This is because it assists you in identifying the region of value on the charts, so you know just where to join your pullback trade. Thirdly, determine your area of value. The region of value in an uptrend refers to the spot on your chart where purchasing pressure might enter and push the price higher. The 20 MA might be the area of value in a strong rise. The area of value of a good trend might be at the 50 MA. Finally, in a weak trend, the value area might be found near the 200 MA or at support. Next, use an entry trigger to time a pullback trade. An entry trigger is a pattern that allows you to enter a trade once all of your requirements have been satisfied. There's no need to overthink this because an entry signal might be as easy as purchasing on a downturn or a breakthrough. For example, in a healthy trend, the pullback is healthy and it may retest the 50-day moving average or past resistance turn support. These are locations to seek purchasing opportunities. Next, look for a bullish reversal candlestick pattern such as the hammer, bullish engulfing pattern, and so on as an entry cue to go long. Lastly, use exit strategies to safeguard your account and maximize your earnings. Now there are 2 sorts of exits to consider. When you're incorrect, leave. When you're sure you're correct, leave. Here's a strong trend market scenario. There's a chance that the market will move against you after you enter a deal. So, where will you exit the losing trade, also known as your stop loss? When your trading setup is invalidated, you want to quit the trade. As an example, the area of value in a strong moving market is around the 20 MA. So if the price falls below the 20 MA, the value area has been violated and you should leave the trade. Next, when you're confident that you're correct, leave. What if the market turns in your favor? How would you leave your winner? Here's an example. In an intense trend market scenario, it's great to ride the trends since the pullbacks are shallow, making it simple to hold onto your winner. Do let me know your thoughts regarding all of this in the comments down below, and I'll catch you guys later in another video. Bye now.